If you want to invest in line with your values and make good returns, focused on long-term sustainable earnings, not just short-term profit maximization, it sounds like you want to invest sustainably, ethically. At the end of this video, I will explain a little bit more about how you can demystify the process of selecting some funds yourself if you do not have access to a financial advisor. As Professor Meir Statman argues in his book, Finance for Normal People, the assumption that investing is a purely rational pursuit of a utilitarian benefit, it's just about making more money, is simply not true. Investing is done by normal people who want utilitarian, expressive, and emotional benefits from all the products and services they purchase and consume, including their investments. In other words, it's perfectly normal for investors to apply non-economic filters. Ethics can be a grey area. Plastic is a very useful substance, and we can't stop consuming all goods. The question is, how do we use resources sustainably, and what does that even mean? At times, all these decisions can just feel overwhelming, including how to invest. Sustainable means maintaining a certain level, a path to meet the needs of the present without compromising future generations' ability to meet their own. I actually found this definition and really liked it, and it's from a book called The Do-Gooder's Guide to Investing by Adrian Reeve. It's quite US-centric though. Data also shows that sustainable funds have the potential to perform better. Also, sustainable funds have shown higher survivorship rates than traditional funds over the past 10 years, meaning fewer sustainable funds have closed down. Asset inflows in sustainable funds are growing fast. There are two factors: the real risk of global warming, both for society and for investments, and a shift from looking at profits for just shareholders and just short-term profits to true value to all stakeholders, which ultimately does benefit the corporation, the stakeholders, as well as society. Ethical investing has many names. Some include green investing, socially responsible investing, ESG focused, impact investing, thematic investing, purpose-driven investing. I wouldn't worry too much about these labels. All it is filtering what to invest in based on what is important to you. The evolution of SRI, or socially responsible investing, really started with a focus on what investors didn't want. This is called negative screening. For example, controversial weapons, tobacco, or thermal coal. We also have positive screening, like support for health and education in the local community. Impact investing started with philanthropists and investors wanting to invest money and do social good, while also holding on to their capital and receiving financial returns. Impact investing funds focus on the 17 UN Sustainable Development Goals, such as no hunger and responsible consumption. These funds support positive initiatives like renewable energy or affordable housing and focus on benefiting stakeholders and the community. A good example of a business that focuses on corporate social responsibility, CSR, in local communities is Danone, which helps to distribute nutritional yogurt to fight against malnutrition in Bangladesh, while also helping farmers and local women earn a living. There's a really great book called Building Social Business by Muhammad Yunus, which talks a lot about Danone and some other social businesses. CSR is about how a company relates to its stakeholders and the world around them over and above just profits. ESG refers to an investment process used more and more even by conventional funds and investment firms to filter out criteria for issues with financial and material risk. ESG stands for environmental, social, and governance, which you probably already know. The E criteria for environment could include how the company's operations look at waste or energy or carbon emissions. The S is for social, and therefore it looks at the human aspects, the people aspects, which are quite important in the whole of the ESG. And you would look at things like supply chain, how employees are treated, employee well-being, and so on. There's also significant reputational damage when an employer gets this wrong. We've seen during this time of COVID-19, some employees have been paid quite fairly by companies like Patagonia, and other companies have responded in not so kind a way, receiving a backlash. Recently, Boohoo, a UK apparel company, was in the headlines for allegations of sweatshop factories, modern slavery, and poor working conditions. And the G refers to corporate governance, so things like board pay, gender diversity, and so forth. Companies that score high on ESG tend to be well-run businesses that treat their stakeholders well, address their environmental challenges, enjoy more conservative balance sheets, and have lower levels of controversies. They tend to be more resilient during market downturns. Another way that you can engage is as a shareholder or as an annual general meeting AGM activist. You can find out more about this in the UK at shareaction.org. If you have a pension in the UK and it's not ethically invested, more than likely you have about 5 to 10% invested in fossil fuel companies, which may or may not align with your values. So do log into your work pensions and have a look at the top 10 holdings of the funds you are invested in. It's quite easy to spot. You have power to influence your organization at work, and you can use that to ask to invest in companies that you want to. You might believe that payday loan sharks, these are lenders that charge an exorbitant rate of interest, often to vulnerable groups of people, are morally wrong, and you might discover that you have an accidental investment exposure to them. For example, the Church of England, who have a moral stand against loan sharks, discovered they had a small stake in Wonga a few years ago. Wonga, a payday lender, charged an APR, annual percentage rate, of 1,509% and had questionable debt collection practices. Wonga is no more. So, ethical investing is a way to walk your talk, to have financial integrity, to vote with your wallet, and to exercise some of your own personal power in asking for a world that you want. Negative screenings now include a high number of criteria, and this is rapidly evolving. Environmental damage, human rights violations, animal testing, medical and non-medical, manipulative advertising, and so on and so forth. So as you've probably gathered, the focus on negative screening is on avoiding creating harm. Positive screening criteria is more towards looking at what the business is doing operationally to help the local community, education, healthcare, and things like that. So what are the differences between ethical versus not? With ethical, you have a smaller investment universe to choose from, although a rapidly expanding one, with even some conventional funds repurposing to SRI. Not all companies report equally. Smaller companies, for example, may not keep up with larger ones, so that may introduce a bias. And the other big one is fees. However, active sustainable funds charge about the same as conventional active funds, so not a big deal. You do need good old-fashioned HI, like AI, artificial intelligence, human intelligence, and a research team to sift through companies. The research team would look to avoid greenwashing, which is the process of conveying a false impression or providing misleading information about how a company's products are more environmentally sound. Overall, OCF, or ongoing charges figure, for my ethical client portfolios in the UK are around 0.7 to 0.8% per annum. If a client tells me she's fee sensitive, then I ensure we have a thorough conversation and accommodate criteria for lower fund fees too. For some reason, fund charges seem a lot higher in the US. However, sustainable and active funds, even in the US, seem to be about the same. You have a great choice of passive investing too, with lower fees, with big players in global asset management like Vanguard, BlackRock, and State Street getting involved in the ESG world. However, if you want higher quality filtering based on your criteria, the devil is in the detail. ESG passive funds cost a bit more than conventional passive funds, but the differential seems minor, I'm speaking anecdotally from client reaction. Passive funds can hold from 100 to 1,000 companies, so effective engagement is difficult. Smaller companies find it harder to keep up with the level of information required by research houses. This means that large companies like British American Tobacco, for example, can score higher than companies whose operations are focused on finding a solution to cancer caused by cigarette smoke. So if you are an investor and you want to start investing ethically without an advisor, where do you start? By the way, if you need an advisor because you have decided you do not have the willingness or the capacity or the interest to do this research yourself, my top tip is go to a specialist. I will list resources for a directory in the UK so you can find one more easily. You want to find an advisor who is independent, has an active understanding of sustainable investing, is well read on the latest research, and is open to create a solution based on what is important to you. If they say that sustainable investing is not profitable or have negative views on it, find a different advisor. Actually, we could do a lot more in the industry to have standardized processes and practices for retail investors to do their own research. There is no easy rule book or process to follow. However, I'll give you a few tips. Remember, this is not financial advice in any way. My content is for educational purposes only. Therefore, I don't have any fun names in my video today. As I am a regulated financial advisor, I have to be careful. You can use Fund Eco Market to filter through based on the criteria you want. It is free to use and there's also an app that you can download. After you filter through on Fund Eco Market, the best website to go through is a website called TrustNet, which is also free to use. You will have to read through the details of the fund fact sheet, look at the investment objectives and ethical criteria, past performance, performance in relation to benchmark, UK regulation, and any other information important to you to satisfy yourself that it meets the criteria that you have in mind. Also, you can read through the fund prospectus, KIID, Key Investors Information documents for more information. Don't rely on just the fund name. The fund name may contain words like ethical, responsible, clean, green, sustainable, but the lines are getting blurred between traditional funds looking to incorporate some ESG and sustainable investments. You can also look at your cash savings and look at banks and building societies in which you believe in. I have no specific recommendation, but there's a lot of information if you look for it online. Remember, we also have to demand policy action and systemic change. Individuals can't provide subsidies for clean energy or put a price on carbon or deter people from using plastic unnecessarily, but governments can. We need politicians who will support climate-friendly policies. Meanwhile, go easy on yourself. If at times like me, you feel like a hypocrite, remember we simply aren't in control of everything that happens in the universe in order to make perfectly ethical decisions at all times. At times, inadvertently or otherwise, our actions and buying decisions cause harm. And we have to invest how the world is, not how we would like it to be, while also working towards the world that we want. ESG investing has had massive interest, with greater choice being added at rapid speed. My hope is that companies will adapt to thrive in a world that values a safer, happier, healthier quality of life. A world that works for everyone, including beautiful creatures like birds, bees, and fish in the ocean. That's it from me on ethical investing. Happy investing. If you are on Facebook, there are also some really good Facebook groups where you can go and ask questions about SRI funds. There's a Facebook group for women in personal finance, and there is one called Socially Conscious Mustachians. I will link it in the description below.